Hi, I'm Jeff Turnahoy, head of America's research at Lipper, and today I'm joined by Ron Mushak, portfolio manager of the Transamerica Small Mid Cap Value Fund. Ron, thanks for joining me.
Thanks for having me.
Ron, let's talk about the strategy of your fund. What sets it apart from its peers?
I think three things make it unique: the way we value securities, the attention we pay to earnings dynamics, and the emphasis we place on cash flow and balance sheets. In terms of valuation, we use an earnings and cash flow-based valuation methodology, which we think is superior to book value, which is the definition of our benchmark, and the preferred method of many of our value manager competitors. We think book value is more a residual of historical cost as opposed to fair market value. So we think by valuing companies more effectively over time, that will be a source of advantage or alpha for our fund.
Okay.
Secondly, we pay attention to earnings dynamics. We care about companies with improving fundamentals in terms of rising sales, expanding margins, improving earnings, whereas the index and many of our value competitors fish in the value trap. And these are companies that are cheap, but cheap for a reason. And the reason is the fundamentals are consistently deteriorating, estimates are being cut, and valuation is compressing, and the stock price is underperforming. So we want to avoid these stocks and focus on truly fundamental improving companies. So there is an element of momentum to our strategy as well. And then finally, we put not just attention on earnings, but we also focus on cash flow. We want to make sure companies aren't accelerating revenue recognition or deferring expense or both. Also, these companies have a lot of financial flexibility and wherewithal to self-fund their operations, whether it's the interest and principal on their debt, their working capital commitments, or their capital expenditures. These companies don't need outside capital to continue on as ongoing entities. Helps very much in down markets where these type of companies tend to outperform.
Okay, so is that more of a top-down or bottom-up approach?
It's definitely more bottom-up.
Okay.
We use quantitative analysis for initial idea generation, where we filter thousands of companies to a few hundred that we can do traditional fundamental research on. So we have a 15-person investment team that does fundamental research organized around sector. So each analyst within a sector will cover companies up and down the market cap spectrum, whether it's a competitor, a supplier, or a customer, and leverage that information to make the best decision. So quantitative idea generation, team-based fundamental research, and then there's accountability and lead decision making at the PM level, such as myself and my co-manager, Ken Burgess. We also have risk management tools for ensuring prudent diversification. And there's a very exhaustive monitoring process and well-defined sell discipline and replacement process. So we think that this process is very systematic, pun intended, and therefore it's repeatable and we can replicate our record going forward.
Right. So do you think this strategy is a better fit for your more conservative or aggressive investor?
I think we're looking for a more, balanced approach, not looking to target it for just a conservative or aggressive investor. We would expect to do well both in up and down markets. In up markets, we think our strategy would benefit from the momentum element. We look at factors like earnings surprise and estimate revisions, which tend to do well in rising markets. And in down markets, we protect ourselves by focusing on valuation, but also focusing on balance sheet and cash flow, because those type of companies do tend to hold up in market downdrafts.
Okay, so do you have an outlook for stocks this year?
Sure. We're constructive on equities, and that view is reflected in our portfolios. We have a pro-cyclical bent to our portfolios. We think the market can rise 15% or more this year due to a combination of factors. We think earnings growth will continue at a modest rate, maybe mid to high single-digit rate, below potential, but still growing. Valuations are reasonable, not dirt cheap, but compelling, below the average of the past 30 years. So we think there can be some modest multiple expansion, and in addition with maybe a 2% dividend. So when you add that all up, you do get a mid-teens result. I think there could be upside to that forecast if you do get further stabilization in Europe or a reacceleration in emerging markets like China.
Okay, given that fairly rosy forecast, has it been difficult to find good stocks in this current environment?
We're always able to find investment opportunities because of the nature of our process. The quantitative analysis is always generating a list of the best available opportunities at a given point in time. The time will determine what type of opportunities they may be. So in a improving economic environment, in a rising earnings scenario like we are in currently, you would see more pro-cyclical companies, whereas in a downdraft, in a more defensive-oriented market, the names of companies would be more defensive, counter-cyclical, recession-resistant. So there is a rotational aspect to the strategy and the names that will be generated in terms of potential ideas at any given point in time.
Okay, so are there particular sectors you're more interested in right now?
Our biggest overweight is to the technology sector. That has the best combination of value, momentum, and balance sheet and cash flow strength. And those dynamics will determine where we are overweight and underweight. I think it's more interesting where we're underweight. We have material underweights to both utilities and REITs that we find very expensive. In a normalized interest rate environment, these sectors could materially underperform, and our underweight to those sectors could accrue to our relative performance.
I see. So is your expectation for maybe a little less volatility in the year going forward than we've seen historically?
Well, if you look over the past 4 years since the recovery began, volatility's actually been consistently falling. However, that's been interrupted by episodes or spikes in volatility due to macroeconomic or geopolitical concerns that have caused short-term bursts in volatility. I think volatility will continue to trend lower, and perhaps some of these spikes that we've seen over the past few years will lessen and maybe in magnitude and in number.
Okay. Thanks for joining me, Ron.
Thank you.
On behalf of Lipper and Transamerica, I'm Jeff Turnahoy. Thanks for watching.